Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
This episode is brought to you by Latin Excellence. Visit latinexcellence.com. That's Latinx, CELLENCE.com or latinxmovement.com to learn more and shop our merchandise. You are excellence. Hello, everyone. Welcome to another episode of On My Way to Wealth. My name is Luis, and I'm your host. Today, I want to talk to you about year-end tax planning. This is a perfect opportunity. We are in quarter four, November 2021. The year is almost out, but it's a great opportunity for you to take a look at certain things to plan ahead for next year and also see if there's anything that you can do that can benefit you for tax year 2021. When you're filing your taxes next year is not the time to do some tax planning. There's only so much that you can do after the year has passed. So let's be forward looking. Let me talk to you about a couple of things that I speak to my clients during the year about tax planning. One of them is, especially right now in quarter four, a lot of us get open enrollment from our jobs. And this is the time where your employer gives you an open window so that you can then choose your employee benefits. And most of the time, people usually focus mostly on health insurance, and that's a huge one. But there's a lot of little overlooked things that your employer might be offering that you may not necessarily realize. But let's look at health insurance first. It's a great opportunity for you kind of like evaluate your health insurance plan and see how much you used it in the past. Because, you know, if you weren't using it too much, then it might be an opportunity for you to maybe change health insurance plans. You know, if you're relatively healthy and you only use your plan every once in a while, just for like annual checkups and stuff, and your employer offers a health savings account option, it might make sense for you to do that. An HSA, that's the health savings account, is an account that is available when you choose a high deductible health insurance plan. So when you're choosing your health insurance plan, you might notice that one option is the high deductible plan. So normally when I'm speaking to clients of mine that for the most part don't use health insurance a lot, you know, they're relatively healthy, they just go get their annual checkups and there's really not a lot of activity. A lot of the times it makes sense for them to get the high deductible plan because then they have the option of having a health savings account. And a health savings account is a great tool to save for your future with a great tax advantage. It's actually a very unique account that gives you triple tax benefits. I did an episode specifically on health savings accounts, so I'm not going to go into too much detail here, but definitely go to onmywaytowealth.com, go to podcast, and check out the previous episodes that I've done. There's one specifically about HSAs. But ultimately, you can put money on a pre-tax basis. You can let it grow and invest it within the HSA if you don't use it for health insurance. And then you can leave it for much later when you're much older. And if you use it for health insurance, it's all tax-free money that you can use. Or you can wait till after age 65, and it's kind of like an IRA. We just take the money out. If it's not for health expenses, then you just pay regular income taxes like you normally would have on an IRA anyway. But it's a pretty unique thing that you can do. So be sure to take a look at that when you're looking at your open window for enrollment and seeing if you're eligible for an HSA. And this is another opportunity too, because you can, let's say if you're already maxing out your 401k, you can then also put money into a health savings account on top of that. So there's another opportunity for savings. As of 2021, the limits were $3,600 for self-only coverage, $7,200 for family coverage. For 2022, it's actually going a little higher, $3,650 for self-only coverage and $7,300 for family coverage. So definitely take a look at your options and see if this might be something that's good for you. Another thing that you want to look at is the other benefits that are offered by your employer during the year. One of those things could be things like a FSA, which is a flexible spending account, not to be confused with the HSA I just mentioned. The FSA is similar to some degree because you can put money on a pre-tax basis and then use that money to pay for out-of-pocket medical expenses, co-pays, et cetera. The only difference is that the amount that you can contribute is much smaller, and also it doesn't roll over to the next year. So it's kind of like one of those use it or lose it type things. The HSA is not like that. You actually get to roll over the amounts that you don't use. The FSA, flexible spending account, you do have to spend it all by a certain time, otherwise you lose it. So you have to do a little bit more planning as to how much money you plan on using during the year for out-of-pocket medical expenses. But it's also a great tool that you can use. Anytime you can have a pre-tax benefit with your employer, you definitely want to pay a lot of attention because it can save you some serious money. Another things that a lot of employers are offering is mental health options, in addition, like to your health insurance, so be sure that you look into your entire benefits package to see what else is being offered. There's identity theft protection I've seen employers offer. I've seen employers offer food allowances for employees that are working from home. Like if you work for a major company and before there was actually food on location, like they had a dining hall or something like that, a lot of employers are offering some food allowances. I've seen employers offer some fertility options, where they pay a certain amount. One of my colleagues was saying that one of her clients was able to freeze her eggs for free because the employer provided it as a benefit. So during open enrollment, go beyond just comparing your health insurance options because there might be a lot of different things in there that you might be able to take advantage of. Now, while we're talking about open enrollment, the other thing that usually I do towards the end of the year is you want to take a look at your 401ks. Number one, a lot of the times, it's kind of set it and forget it where we start just contributing a certain amount and then we just never look at it again. You want to make sure that you are rebalancing your portfolio depending on how it's invested. Because a lot of the times, to give you an example, let's say your portfolio was originally 70% stocks and 30% bonds, and then stocks go up and you might end up at 80% stock and 20% bonds, where now you have much more stocks than you initially intended to. So then you have to reallocate and rebalance that portfolio to get back to a 70-30. And this is something that a financial planner can help you with, but it's something you want to keep in mind, right? Because you don't want to just let it sit there. It's great that you're contributing, but you also need to pay attention at least once a year to rebalancing that portfolio to make sure that your allocation still matches your risk tolerance. Also, take a look at the investments within the 401k, if it makes sense to just change what you were doing altogether, aside from rebalancing, look at the performance, the fees of the funds and things of that sort, and see if they're still working for you. Another thing with the 401ks is the contributions themselves. A lot of employers are now offering a Roth option, which is basically the opportunity to contribute after-tax money, which can then grow. And eventually, if you follow certain rules, you can take the money out tax-free during your retirement, as opposed to the traditional contributions where you put in pre-tax and lower your taxable income today. But it's a great opportunity for you to kind of take a look at what tax bracket you're in and then determine, does it make sense for me to continue to do pre-tax versus Roth contributions if that's an option, something you want to talk to your tax professional about or your financial planner. But it's something that should really be something that you're intentional about. If you're self-employed, you can also open up your own 401k. It's called a solo 401k. If you're self-employed and you don't have any employees, there's also a SEP IRA. So you want to make sure that as a self-employed individual, you put some money aside for your future self. So if you are self-employed, look into a solo 401k. If you don't have any employees, it might make sense for you to open one up before December 31st, even if you don't contribute to it, because then you can do some tax planning later on next year, as long as the 401k was already open by December 31st. So definitely speak to your accountant or your financial planner about that. Also, for those people that don't qualify for a Roth contribution because they make too much money, maybe it makes sense for you to do what they call a backdoor Roth, where you contribute money to a non-deductible contribution to an IRA, and then you convert those funds into a Roth IRA. That's another strategy where technically you can use the system legally to contribute to a Roth IRA, even if you didn't qualify for one. Great tool to use. So, there's so many opportunities at the end of the year for you to do some tax planning, both for the current tax year and the future year. The 401k contributions, you also want to see how close are you to maxing out? Are you on track? In case you need to do anything, any adjustments on your 401k withholdings now from your paycheck to see if you're on track to maxing out. Also, Roth IRAs. Will you qualify for a Roth IRA based on your income? If not, maybe you plan on doing a backdoor Roth, right? You also have until the deadline for the taxes. So let's say April 15th of next year to contribute to a Roth IRA for tax year 2021. So you can kind of make some planning around that and see if you're able to contribute to that Roth. If you for some reason weren't able to max it all out this year, you still have until April 15th if you qualify under the income limit. So great planning opportunity there. Also, if you have any capital losses from prior years, this is a great conversation that you can have with your financial planner or accountant, is if you have a loss from last year that you weren't able to use, a carry forward loss, they call that. And this year you have actually made some money on some appreciated asset, whether some stocks, some cryptocurrency, anything like that. See if it makes sense for you to actually sell those and offset some of the gains with the prior year losses, so you can do some planning around that. Same thing with charitable stuff. You might be able to donate some appreciated stock and not pay any taxes on it, by donating it to like a donor advised funds. I'm telling you, the opportunities are just endless when it comes to this. If you are at a stage where you are required to take required minimum distributions from your IRAs or your 401ks, another planning opportunity here, if you're charitable, depending on your age, right, and your situation, you might be able to do a qualified charitable distribution and not pay any taxes on the distribution from the IRA, because it wouldn't make sense for you to take the distribution, pay taxes, and then donate the after-tax money. You might as well just donate pre-tax, right? Anytime you can do something pre-tax. A lot of people that take requirement minimum distributions also owe taxes sometimes during the year. So another strategy could be to withhold taxes from the distribution. I've had clients that we do 100% withholding on those distributions and then send it to the IRS. So that way they don't have to owe a tax time. It's just psychological, just not having to write a check sometimes makes you feel good, right? Another thing regarding Roth IRAs is doing a Roth conversion. So what that is as this is separate from the Roth contribution limits. You can do a Roth conversion regardless of your income. All you have to do is pay income taxes on that money. There's no penalty, but it's a great planning opportunity because sometimes we have the opportunity to do this because we might be in a lower bracket. Let's say, because of the pandemic, you didn't make as much money, for example, or your spouse lost their job, whatever the case might be. If you happen to find yourself in a lower bracket, or that next year you're going to make more money and be in a higher bracket, consider doing a Roth conversion. So if you have pre-tax money, either in an IRA or an old 401k, this might actually be a great opportunity for you to convert those funds into a Roth, pay the taxes now so that you don't then have to pay taxes at a higher bracket later. Great planning opportunity there. Something that we as financial planners do very often with our clients, because you have to take into account a lot of different factors like the tax brackets, and also if people are closer to being on Medicare, that also may trigger some taxation of the Medicare premiums later. So there's a proper way of doing it, but I just wanted to kind of just plant that seed in your head. I also wanted to mention some things that were specific to 2021, because so many different things that are new. For example, for those of you that have children and we're getting the advanced child care credit, one thing to emphasize is advance, right? So what that means is that you're getting money ahead of time, which will then be deducted from the refund that you normally would have gotten, right? So those of you that have been getting the advanced child care payments, number one, be mindful that this was in advance. And number two, so that way you're not disappointed at tax time if you're expecting a bigger refund than usual. And number two, keep track of how much you got. Very likely you'll get a letter from the IRS stating like how much you got. But I've seen with all these credits and the stimulus payments, a lot of people never got the notification from the IRS. So keep track of how much money you actually received, because when you go file your taxes next year, one of the questions is how much advanced child tax credit payment did you receive, so that it could be adjusted properly and calculated on the return, so that then you don't end up getting either too little or too much, right? So you want to keep track of those. That's one thing that very important for next year. Also, if you happen to be charitable, for 2021, you can still donate up to 100% of your adjusted gross income. which is a huge opportunity there, especially if you couple that with a Roth conversion, for example. This is advanced planning strategies. People that are charitable, you can donate on one end, convert to a Roth on the other, and kind of offset some of that. So that's something you want to talk to your financial planner and your tax professional about as well. And anything in here, right? I'm just giving you some information so you can be educated, kind of get the brain rolling into all the opportunities that you could take advantage of during the end of the year, which is a lot better than waiting until next year. The thing pertaining to 2021 is going back to charitable contributions. Even if you don't itemize your deductions, the CARES Act benefits were still expanded for 2021, where you can still deduct up to $300 if you're single, even if you don't itemize. So if you donate to charity, actual cash, right, up to $300, you can deduct that from your income, even if you don't itemize, and $600 for couples married filing joint. So that is the last thing regarding 2021. It's not meant to be all inclusive, but I just wanted to give you an idea of the most common strategies that you can use. So yeah, I know I threw a lot at you, obviously, but definitely reach out to your financial planners, your professionals, your CPAs, etc. See if it makes sense for you to do any of these strategies. What can you do at the end of the year? Just make that a habit. There's a tax season and there's a tax planning season, right? Which is right about now. So you definitely want to take advantage of those. So thank you all for tuning in. Appreciate you guys as always. If you have any questions, send me an email, luis@onmywaytowealth.com. If you want to schedule a complimentary consultation, go to buildabetterfinancialfuture.com, click on schedule a call, and I'll see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.